remember, you're lending the money to the U.S. government for 10 or 30 years at a time at a fixed rate. So you want to think very long and hard about what rate do you lend money to the U.S. government, which is running a staggering deficit, that is now running very easy monetary policy relative to the inflationary pressures that we're facing.
Ken Griffin of Citadel there talking to our Danny Berger. Now, joining us for our macro roundtable is Kurt Ryman, head of Fixed Income Americas at UBS Global Wealth Management, as well as George Borey, chief investment strategist of Fixed Income at Allspring Global Investments. Kurt, let me start with you. Ken Griffin talked about the bond market being anxious. You heard someone else describe the bond market as being dazed and confused.
Yeah.
What's your take?
Yeah, it's in a range. Estimates for the year ahead consensus is really tight. There's not a whole lot of variation. I tend to think that the 10-year is moving directionally lower. I would be biased towards thinking that by this time next year, we'll be looking at a 10-year that's below the 4% threshold. But it's not going to move in a straight line. And I think that's the point that Ken and others were making, is that next year, the growth picture in the early part could turn up because of fiscal stimulus, the checks that people will be getting from the tax refunds from over withholding from this year, together with what I think next year could be in a midterm election year. Some efforts that could come along to try to boost things a bit. And then we have the Supreme Court decision on tariffs. And I think that's a really important one that we need to be on watch for. Do they allow refunds? Will that further impact the deficit picture if they do allow the refunds? So some big questions. I'm not surprised that bond investors are looking at the market and saying, okay, right about this level next year. But I think we're likely going to be seeing the bond market move around. We wouldn't be lengthening our duration or picking up interest rate risk until we get a little bit more value in the 10-year sector.
All right, so clearly there's a lot of reasons for there to be anxiety in the bond market. George, the question now is how reliable the data that we do get is. And the November jobs and the CPI, kind of put that into question here. At what point do you regain full confidence in the data?
It will take time, and the data is noisy. It's actually very noisy. I think there are a few key takeaways that at least we can kind of glean from what's been released so far. On the labor side, there is sort of softness. There's softness in the labor market, but it's not acute, and it looks like we're starting to find maybe perhaps a new equilibrium. It will take us a few months to get sort of clarity to ensure that, but the data does suggest that. The job market is actually doing a little bit better. On the inflation front, the data is clearly very noisy, but the one takeaway that we saw was that inflation doesn't appear to be accelerating, that we're probably still right around that 3% level, and that there's a good chance that disinflation does start to emerge, but it probably takes at least deep into the first half of the year, which is why we think the markets have reacted as they have. And when we look at the term structure, we see a front end that's very well anchored, that's very well anchored by central bank expectations. And then we see the long end as the relief valve in the market. And so, as Kurt mentioned, expecting perhaps the 10-year to come down a bit is not a bad view, but you're probably more likely just to see a steepening that looks more like a twist, with the front end coming down and the long end, it's sort of staying high. And it wouldn't be a surprise to us to see the 30